Hi, it's Melissa Joy, and I am so pleased to be joined by Melissa Fradenburg. We are colleagues at Pearl Planning. We're financial planners and financial advisors, and we want to make sure that we're communicating to you about Ukraine and the investment markets, because I know that's one question that is on top of client minds and the minds of our community. Melissa, thank you for joining me.
Yes, thank you for having me.
Well, we just put together about 10 minutes of conversation for information about Ukraine investments and your financial plan. We want you to have information that will be relevant and useful for how you can think about the Ukraine crisis in context of your money, as well as some tools for you to kind of manage through. So our agenda today is going to be talking about the Ukrainian crisis and current market environment, as well as peppering in history's investment lessons, and then really emphasizing how you can manage through an investment crisis, whether it's geopolitical or other. And certainly those pieces of advice apply to today and frankly, always. So we know that Ukraine is in the news. It's in the hearts of many. It was invaded by Russia last week. We're recording this on March 1st. And so this is just an accumulation of headlines that you can see in Europe that were taken last week in The Guardian. And so that invasion has deepened what has been a negative start to year for both stocks and bonds, although stocks and bonds are having different reactions to the most recent news. And one of the important things that we want to provide context for in this conversation is that anything that we're discussing when it comes to economies and investments does not supersede the humanitarian and geopolitical impact and consequences and seriousness of this conflict. It is a tragedy with huge human toll, and we want to make sure that we are clear that talking about your investments when in context of the Ukrainian crisis does not mitigate any of the concerns of this war. One of the things, though, that we like to provide for context is a list of major geopolitical events that have occurred throughout modern history, going back to World War I or World War II, excuse me, and the impacts in terms of how investments reacted to these events. So this is a data set that was taken and put together by LPL that goes through 2020 with some major disruptive, surprising events, starting with Pearl Harbor. And then you have a look at what happens over a short period of time. A total drawdown would mean how far down did the market decline? And you can see in yellow at the bottom that on average, markets declined about 5% with these unexpected geopolitical shocks. And then the calendar days from to the bottom and to the recovery are how many days of trading or in the calendar in the month did it take for the market to kind of bottom out or stop going down. So that was on average 22 days. And then calendar days to a recovery is when the price of investments taken as a group recovered back to where they'd started prior to the event. So you can see that as 47 days or just within a couple months. Now, no crisis, no uncertain time is average. So we just take this past performance in this history and we use it as an indication of the future, not a prediction of the future. But I do think it's relevant to provide you that context because certainly I know that people are concerned, first of all, for human life, but also for the impact to the world's economies and to your personal investments. Well, so I think you have some context about Russia and the Ukraine in terms of how they fit into the world's markets.
Certainly, and yes, I want to put the size of the Russian economy as well as their equity markets into perspective But absolutely, this conflict will, in addition to the human toll, will have an effect on the supply chain, particularly oil prices and commodities, due to that being 50% of their economy is oil and the rest is mostly precious metals. So there are certainly, especially in Europe, going to be some economic effects from this conflict. What I do want to mention, though, is even though Russia is large in size, when you look at the map, if you look at their economy, if you look on the right compared to the state of California at 2.7 trillion, Russia, if we were to rank it with our state's economies, would be number 3. And again, being a country, that just puts that in perspective, and then Ukraine would be number 34. So the size of the Russian economy is small comparatively to the size physically of the country. And then if we look at the equity markets, if Russia and Ukraine's equity markets were S&P 500 companies, Russia would be number 26 and Ukraine would be number 505. So again, Russia at 251 billion versus Apple at 2.6 trillion. That equity market, again, to put it in perspective to size to the US equity market, is something that we want to think about when we think of the impact to your investments. Now, moving on to kind of the human reaction. When you see all those headlines that Melissa went over and discussed, I mean, it takes my breath away, not only for obviously the conflict and the human toll, which Melissa did touch on, which is so important, but that idea of what is the market going to do? What's going to happen to my investments, right? So going back to caveman times, our human fight or flight reaction would be to panic and want to, take risk off the table for our portfolios. Now, while this is normal human nature, and again, going back to that caveman or cavewoman time, what I want to show you on the next slide is why that is not the right reaction in this particular situation. So on the left-hand side, the green chart there is showing if you were just to take $10,000 and invest it in the S&P 500 index between 1979 and through the end of 2020, that $10,000 would have grown to $777,649. And that's, just putting it in there and not touching it. Certainly that's excellent growth, something that we like to show people to put it in perspective. However, if you were to look at two reactions, right? The apprehensive investor who, again, it is human nature to feel like you want to take money out when the market is uncertain. So if you were to look throughout that time period, again, 1979 through 2020, there were 17 times marked by either the yellow dots or the red dots where the market pulled back 8% or more in a month. And again, when I say the market, I'm talking about the S&P 500 index in this case. So every time there was what we consider short-term volatility, so down 8% or more in a month, you pulled $2,000 out and put that into cash. And we're using the 30-day T-bill for that. In the orange graph on the bottom, so instead of your money growing to 777,000 and change, you're now at 468,054. That is showing you that when you pull money out on the dips, how much you're affecting your long-term growth. Now, goes against all of that human nature to do this, but we know from history that it's the best thing to do, which is when the market pulls back and that short-term volatility down 8% or more, is to make additions to your equity investing. So if you were to put $2,000 in additionally from that $10,000 investment for 17 times over that time period for a total of an additional $34,000, that makes the difference of almost or double what you put in. So instead of 777,000, you're at 1.592, 776 on the blue graph here on the right. This is so powerful to just illustrate what that is. And we call that buying the dips. Buying into that short-term volatility is one of the best things you can do for, again, that long term, which hopefully your equity investments are earmarked for those longer term investments, and really to put it in perspective and show you there how that can work for you when you move against that human behavior of panic. And with that, I'm going to turn it back to Melissa.
Thank you, Melissa. I think that's really helpful. And it's so easy to say that you have a plan to add more money when times are good. But in that moment, when you're facing fear and uncertainty, your natural instinct, because of your explanation of that, very ancient evolutionary desire to fight or flight, it's much more difficult to do it in the moment. So I love that lesson. Another
Yeah. And
important
just to
lesson.
be fair, it is difficult for us as well. Even in this industry, even though I look at the graph and I know that it's the right thing to do, it is absolutely really hard to do.
Now we have to hardwire in the process, right? So that is an important part of your conversation with your financial planner. How have they built in a process, not just for when things are going up, but for when things are going down as well. And we talk a lot about clients, especially when we start working with them about that. And I think another important consideration in these mini nuggets of lessons is, just like there's a lot of commentators talking about either Russian or Ukrainian, or I should say probably Russian and Ukrainian propaganda, and kind of half truths or false tales that are occurring right now, both in media, on the internet. I like to use this example where everyone is really focused on the geopolitical propaganda to remind people not to succumb to investing propaganda as well. So I started to see the headlines right away over the past couple of weeks of, this doomsday times when it came to investing. You have no idea how bad things will be. Listen to me, kind of that shiny Chicken Little type, or the boy who cried wolf. And you need to be really discerning about who you listen to. And remember that if you're watching headlines, clicking on articles, or paying attention on the news, a lot of times those outlets get more payment for either eyes on the screen or clicks. And so they may not be trying to give you the best advice or information, but instead they may be trying to alarm and scare you, because that is helping them to have good metrics and to get paid. So do not be distracted by the alarmist kind of fear culture. At least that would be my recommendation. In fact, here's a reminder, because there are a lot of opportunities for fear and alarm. This is two pieces of information, one set of data. It's a look at the last 10 years of return of the S&P, but it's presented in two different ways. On the left, you have the growth of the S&P 500 as measured in percentages over the last 10 years. And this was taken through February 28th, so through the end of February, and you have 200%, more than 200% returns during that time period. But if you look at the chart on the right, anytime there's not an all-time high, anytime the market is not equal to the new highs, then that purple line dips below. So that's all the times that the market was kind of selling off or trading below where its all-time high had been in the same 10-year period. And of course, if you look at the chart on the left, things look easy. You say, no brainer, I would take that 200% plus any day of the week. And as we've mentioned before, past performance does not predict future returns, but often history can rhyme. But if you compare it on the right, there's many difficult times, especially you see the big dip, which is March of 2020 when COVID hit. There are many times to be kind of shaken loose from the market. And that's exactly what that propaganda about bad markets really preys upon. So keep in mind that you don't want to give in to the urges to overreact. You do not want to deviate from your long-term financial plan due to headlines today. And we love this money visuals image that talks about a comparison of your very long-term financial plan, which has your financial goals and what you want to do with your life, and the money that you'll need to accomplish that, really written out and thought of over time, versus daily market movements, which have a lot of opportunity to kind of getting shaken out and abandon that plan and abandon that investment process. So choose to focus on your plan. If you are listening to this and you do not have a financial plan, then take our advice and work to find a financial planner so that you can develop a financial plan that has something that you can hold on to other than market headlines when you think about how you're going to be investing and making financial decisions. And we'll just leave you with this quote, which I think is just a fabulous quote. Holding stocks in a bull market is practice. Holding them in scary times is the Super Bowl. So kudos, Mike Antonelli from Baird, for mentioning this. We absolutely do think that, it's really easy to practice good investment discipline when there are times of low volatility, but go back to your process and remember that you built, hopefully, your investment process, and we know we did, for days like this, and remember that the process will and can guide you through. If you have follow-up questions, don't hesitate to follow us for future, pieces of information. We're disseminating this on social media, and here's how to reach us. But also don't hesitate to reach out to me, Melissa Joy, melissa@pearlplan.com, or Melissa Fradenburg in our Grosse Pointe office, melissa.fradenburg@pearlplan.com, for any follow-up questions. Anything you'd leave us with, Melissa?
No, same thing. If you are currently unsure what to do or don't have the guidance you need and looking for help, Melissa and I would be happy to help guide you and get you focused on your financial plan as opposed to the daily volatility. And, just close it out with my hearts go out to everyone that is affected by this directly in the conflict with Russia and the humanitarian toll that this is taking. But again, as far as the financial situation that we are currently in, if you need help putting it in perspective, please reach out to us.
Well said, Melissa. Thank you.